Welcome. Today, we're diving into a major tax law update, the most significant since the 2017 Tax Cuts and Jobs Act. This new legislation, signed in July 2025, offers plenty of new advantages, adjustments, and opportunities for taxpayers like you. Whether you're retired, still working, or managing a household, there are important steps to consider before 2026 to maximize your benefits and avoid potential pitfalls. Over the next few videos, I'll walk you through these changes, so be sure to subscribe and hit the notification bell to stay updated. Now, let's break down 5 key actions you can take to reduce your tax burden in the coming year. 1. Review your deductions. If you're over 65. Starting in 2025, seniors age 65 and older qualify for a bigger standard deduction. On top of the existing bonus, you'll get an extra $6,000 deduction. For singles over 65, that means a total deduction of up to $23,750. For married couples, where both spouses are over 65, it doubles to $46,700. This could lead to substantial tax savings. For example, couples in the 22% tax bracket might save over $2,600 annually. But be cautious. This bonus deduction gradually phases out if your income exceeds certain limits. For couples, it starts phasing out above $150,000 of modified adjusted gross income and disappears after $250,000. Singles see the phase out between $75,000 and $175,000. If your income is near these thresholds, be careful about actions that increase taxable income, like converting a traditional IRA to a Roth IRA, which could eliminate your bonus deduction. If you plan to convert, consider spreading it over multiple years to stay below the limits. 2. Homeowners. Take advantage of increased SALT deductions. If you live in a state with high property taxes, this change could benefit you. The SALT deduction cap rises from $10,000 to $40,000 starting in 2025. This means you can deduct up to $40,000 for state and local taxes, including income, property, and sales taxes, especially helpful in states like New York, New Jersey, and California. Keep in mind, this cap increases by 1% annually until 2029, then reverts to $10,000 in 2030. However, if your income surpasses $500,000, this deduction begins to phase out and is eliminated completely at $600,000. Large, one-time income events like stock sales, big retirement withdrawals, or IRA conversions can affect this, so timing is crucial. One smart strategy is bunching deductions, grouping payments like charitable donations or property taxes into one tax year to maximize deductions. For example, paying your 2026 property taxes in December 2025 allows you to deduct both years' payments on your 2025 return. 3. New rules for charitable donations. Starting in 2026, if you don't itemize your deductions, you can deduct up to $1,000 in charitable gifts, or $2,000 if married filing jointly. This is a helpful benefit for those who take the standard deduction. Note that donations to donor-advised funds or private foundations don't qualify. Only direct gifts to charities do. If you itemize, there's a new limit. Your deductible donations can only exceed 0.5% of your adjusted gross income. For instance, if you earn $100,000 and donate $700, you'd only deduct $200. So, if planning large donations, consider giving before 2026 to avoid this cap. 4. Maximize your health savings account, HSA, benefits. The law includes new provisions to make HSAs more flexible starting in 2026. You'll be able to withdraw up to $150 per month, $300 for couples, tax-free to cover direct primary care or concierge medical services. Also, enrolling in direct primary care won't disqualify you from HSA contributions, provided you have a high-deductible health plan. Another important update is that telehealth services no longer require meeting your deductible first, making virtual care more accessible and affordable. The open enrollment window for health insurance marketplaces shortens to November 1st through December 15th starting in 2026. states won't be able to extend enrollment past December 31st. Additionally, you'll need to verify income eligibility before enrolling to qualify for premium tax credits, not after, like before. If your income increases during the year and you don't update your marketplace account, you might have to repay extra subsidies when filing your taxes. This makes keeping your income information current more important than ever, and planning financial moves like Roth conversions or capital gains with healthcare costs in mind is essential. Before 2026, here's your checklist. Consult a financial advisor about how these new deductions affect you. Plan Roth conversions strategically. Manage your income if you live in a high-tax state to maximize SALT deductions. Be intentional with your charitable giving. Align your health coverage and HSA strategies with the new rules. By acting early, you'll position yourself to benefit the most from these changes.